Hello again, this is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Markets are moving big in a big way and a lot of headlines to discuss, so let's get right to it and thanks for watching. So this is the reoccurring theme that we saw as a spillover effect from February. The 10-year Treasury over the last few weeks has spiked. And today, again, after Jerome Powell was speaking at a Wall Street Journal conference, he basically gave some overly dovish comments saying he's going to be supportive of interest rates lower for longer, as he's been consistent all the way through. But the market is, specifically the 10-year Treasury, is seeing right through it, because ultimately what the Federal Reserve also is trying to do is increase inflation. So longer down the road, if you will, maybe a year, 2 years from now, they can start raising interest rates. Well, markets are always ahead of sort of the intent, right? Intent of sort of a company in terms of earnings. It's always anticipating, so stock price would go up or down as a result. And it's also anticipating the Treasury yield right now, specifically the 10-year. It spiked just after he spoke. And so I keep bringing this to the forefront because it has a immediate impact as to why the market is down. So let's go back a little bit of a history lesson. So if you're following our daily updates, we're going to a Tuesday, Thursday cadence for just a bi-weekly update as it relates to what the markets are paying attention to. And very specifically last year on one of my daily updates, I had this chart. And the chart was talking about the leaders of the S&P 500. If you take out stocks and you categorize them in 11 different categories, a sector specific, you could see the overperformers and underperformers. Well, I'm going to take a history lesson here, going back in time when I had this chart last year, and I was showing the best performing as a percentage relative to their strength and the S&P 500, the sectors. And we had industrials, materials, staples, healthcare, and obviously technology in this subsection. But you saw the significant outperformance up here. Down here, you had real estate, financials, utilities, as well as energy as the lagger last year in terms of performance. Well, year to date, guess what? Guess what's actually leading right now? You have energy and financials, and real estate is now leading the charge. And so this chart theoretically could be almost flipped year to date. And why is that? Well, when you have higher interest rates, right, the 10-year Treasury affects these positively. Bank earnings become positive. Energy is also seeing some changes out there with some stabilization in the oil prices and commodity prices spiking. So you have a change in leadership. Now, is it a value trap? Meaning, is it just a short-term trade from growth to value? Keep in mind, value has been underperforming growth for over a decade right now. We believe here at Blanke Schein Wealth Management not to panic, right? Just to take everything in stride. Everything in this category right now has a significant capital gain in most cases. So, and they're long-term holding. We're looking long-term here for our clients. So they're high-quality companies, really well managed and positioned properly in the space that they should be in. So some consolidation is quite all right? Especially if you're owning high quality like we do. However, we also allocated to the underperforming asset class way back when, and we're continuing to do so. So we obviously rebalance proactively for our clients here at Blanke Schein Wealth Management, simply because you want a balanced portfolio. Diversification is good. And that's it. That's my update for the day. You just saw that. It couldn't take it anymore. But anyway, the long story short is the 10-year Treasury yield is still in full effect. And it really is the show while Jerome Powell is the sideshow. So this will continue to play out. We believe it's a consolidation right now of essentially just the growth, taking a breather. They were 52-week highs just not too long ago. And so they're just going to have a midterm, short-term correction of the last month and a half, and some consolidation before we believe they will grind higher once again, as well as financials and energy and all the rest that were lagging last year are catching up. Remember, again, if you watched, I was talking about the analogy of the Schein family, my 4 teenagers, and my wife and I, running up the hill, doing a hike up the hill. So what's going to happen? Well, if I'm the energy and the financial sector, if you will, I'm going to be last. And my kids are going to run up. They're going to be midway through the mountain, and they're going to have to stop and wait because they've spent all their energy, and they're going to wait for mom and dad, slow and steady, to bring up and meet them halfway. But once we're there together, guess who's going to take off once again? It's the technology, or the kids, the teenagers. They will continue to run, and they will continue, probably most likely, my Ashley, who's the fastest in the Schein family, will win, and she is the technology sector. So I think, after waiting for mom and dad midway, and then starting again to the midway to the top of the mountain, she's going to beat us all. So consolidation's healthy, rotation's healthy, but it's okay to see other underperforming sectors catch a bid and start really performing well year to date. So that's a summary of what's happening. Again, I'm going to continue to talk about the 10-year Treasury because it's really indicating the health and the future growth of the U.S. economy. So that's our update for today. Thanks for watching.